afternoon, and welcome to Barometer Readings. David Burrows is away today, so James Callahan and I are here in his stead to give you a flavor for the markets over the last week and in general, and to talk about how the portfolios are being managed as a result. David will be back for the next Barometer readings next Tuesday. Thank you for joining. Stock markets took a bit of a beating since we last met. Not really a beating. It's funny I say beating. Last week, the market was down about 1.6%, but we've been skirting highs, and so it felt a little bit soft. And some of the momentum stocks and the most volatile stocks have sold off a little more than the market as they've rallied more than the market. The last few weeks, for those of you that listen to our weekly webcast, David would have told you that have been characterized by weak breadth. And last week in particular, the market has been weaker than normal. So although the S&P 500 was only down 1.6% and the TSX was about 2%, it is telling that down that little felt so weak. The US government shutdown has started weighing on people's minds as it became the longest government shutdown ever, even affecting air travel. So minds have turned to questioning whether this will now add downside risk for the fourth quarter economic growth. In addition to clouding our visibility into economic performance, we now must take more seriously the possible damage to activity. Available indicators, because we didn't get data for a while now, so available indicators are painting a picture of a labor market that is soft, but not deteriorating rapidly. And in the absence of official data, Fed officials have pushed back against assuming a December rate cut out of the Federal Reserve, which the markets really want to see and have largely priced in. Here in Canada, the TSX was also down about 2% last week. Both indices have tested and held their 50-day moving average, which was nice to see, which is the first level of support. Holding this support will be the difference between this correction being healthy or the beginning of something else. Most of the decline in both markets resulted from a sell-off in mega cap stocks, which have been quite the leaders since the beginning of this last leg of the rally. Momentum, large cap, and speculative stocks and low volatility held up well. So safety and stability held up okay, and speculative stocks led the declines. Energy and materials also held in okay. We are at the end of the earnings season in the US, but in the midst of it in Canada. And so far, both countries' companies have reported pretty decent earnings. We also posted a very good employment report here in Canada on Friday. We added 66,000 new jobs in October, much higher than expectations. And although the bulk of it was growth in part-time jobs, which is good for the youth that has been experiencing much higher unemployment than the headline number would suggest, it was very nice to see. Some point to nervousness by employers in that they preferred to commit to part-time jobs rather than full-time, but we'll take it. Unemployment rate went down to 6.9% from 7.1%. So as a result of the weak breadth, as it is our strategy, we have judiciously sold stocks as they broke down from where we thought they should hold. We got out of the, we took some profits in some of the golds and booked some nice profits for our clients. Small cap volatile stocks like Kraken Robotics, Shopify, which is not small, and Stantec have also left our portfolios or gotten deweighed. We currently hold about 15 to 20% cash, waiting to redeploy should this be a healthy correction, but ready to increase it should it prove to be something else. James will talk in more detail about the portfolios a little later. So I have compiled the charts I thought were interesting from the week to share with you. So let's begin. As mentioned, the data points that we have are pointing to a stable employment picture in the US. This is private sector employment versus Bureau of Labor Statistics. Since we do not have the orange line, which is the BLS, Bureau of Labor Statistics, due to the government shutdown, we watch the blue line. The two lines tend to mirror each other, so we can extrapolate in the absence of the Bureau of Labor Statistics. The blue line ticked up, indicating more private sector employment. So that is very good. Um, Anecdotally, we hear about layoffs. We heard from Amazon last week, but initial weekly claims remain in a subdued position, which is great, as it is a pre-data point to employment. So stability is wanted, and so it doesn't add pressure to potential increases in unemployment. Um, Quarterly year-over-year EPS growth relative to expectations. Like I said, earnings season is almost done in the US, and we are still in the midst of it in Canada. This chart gives us the quarterly earnings expectations, and then the dark circle tells us what the earnings growth actually came in as. For the third quarter, we don't have a blue dot, but you can see that expectations here have been at 6%. We are currently coming in at low double digits, which is excellent. Generally, as you can see, earnings growth have beaten expectations quite substantially over the last few quarters. Now, this is indeed a trail off in earnings growth, but nevertheless, low two digits is pretty attractive. We get 15% growth last fourth quarter of 24, and it'll be a hard number to beat when we look at next quarter, but this still paints a pretty decent picture. Now, despite the fact that it comes at a time when comps will be hard to beat at 15% growth, like I mentioned, analysts are happy to revise the earnings expectations up, meaning that what they see and hear from talking to management companies give them confidence to do so at this point in time. NVIDIA is expected to report next week. This is currently the most important company in the world, and it will play a big role in the earnings growth picture. So everyone is watching this, whether you own it or not. Of late, and given how large it has become, while earning growth is there, it has really gone from outstanding to excellent, and the volatility of the stock around the earnings window has subsided. So that will be helpful. Over to the TSX, approximately 80 companies out of the 212 have reported in aggregate. They are showing a sales growth of almost 4%, and an EPS growth of 6.5%, which is nice. Energy showed a positive surprise of 9.5%, despite the fact that you're seeing a 7.5% decline in growth. And the companies have reacted very well. We hold Imperial Oil and Tamarack, and they both did very well. Technology, a darling here and in the US, showing sales growth of over 20%, think Celestica, and earnings growth of about 14%. We still hold Celestica, though we took some profits and brought clients back to a lower weighting given the recent volatility. And we'll be watching and making sure we are not there should it break down, but for now it's holding. Despite the weakness in the markets, this is a chart showing us total call option volume. Now, it continues to be very elevated, which is a sign of appetite of the market. Reminder that buying a call option is a right to buy something at a predetermined price. And obviously, the only time you would opt to exercise that right is if the price is higher than what you contracted for. So the advantage is that if you don't exercise that option because it is not in the money, you only lose your premium. So it's one way to buy stocks without having to put up all the money. It's a very popular one, and there is still very good appetite for that. So bottom line is that there's still very high interest in this market. Um, Interest in the Mag 7 is still very high, although the earnings growth seems to be tapering. The blue box around that 14 and 4 number shows you this quarter. Growth of 14% for a couple of quarters is still not bad, although it really comes off the huge 35% that we've seen in the middle and 32% in the middle of last year. So when you hear people saying, oh, but their growth is declining, it's true. It's still about 3 times the growth in the rest of the market. So people still like it and want to pay up for growth. And with NVIDIA, maybe it goes a little higher, maybe it goes 16, 18. Nevertheless, it's still a tapering. But so still the growth engine and still investable, don't get me wrong, but the market always tries through trial and error to price this right. And this is why the last few weeks have been a little more challenging for this cohort given their growth rate and PE. But we are underweight the sector. We have a very selected technology companies in our portfolios. I've already mentioned NVIDIA. So moving on, this chart shows this performance of all kinds of AI baskets, the AI Power Index, the AI Exposed Semis, the Mag 7, the data centers that have been in play as being needed for all this AI development, the Goldman Sachs TNT AI basket, and the yellow line is the S&P. So all these baskets have outperformed the S&P substantially, so there is profit to be taken. So as it relates to the weakness in the market in last week, it's understandable why this is the cohort that people would take most profit in. Now, what happens to S&P returns during government shutdowns? They've actually been okay. No, kind of flat this time around because it's gone on so long. So now, yesterday was an amazing day in the market. We got back everything we lost last week. So market was up 1.5% yesterday and was down 1.6% last week. So we're kind of flat if we were to look at a week and a half out. Volumes have dried out a little bit. It's eerily quiet out there. People are skittish, and I sit on the trading desk, so I know that people are finally starting to buy some protection. Remember what I said, you buy an option to protect your holdings. You will be buying a right to sell, and if the market rallies, you don't have to exercise that option. So it's just like insurance. You buy insurance on your house, and you hope that you just pay the premium, but that nothing happens. Canadian employment, as I mentioned, moving back to macro, was very, very good. The black line is the unemployment rate, and it ticked below 7% to 6.9 unexpectedly, which is wonderful. And Canadian employment increased by 66,000 jobs, well above consensus calling for a 5,000 job decrease. The participation rate, meanwhile, increased 1 tick to 65.3%. What stands out here, though, is the annual change in wages. That's the red line there. It has been ticking up, the red line, what with minimum wage increases as well that just started this month. This is a great positive, in my opinion, and is supportive of the fact that the Bank of Canada is probably done cutting rates for now. This chart shows hiring intentions versus labor shortages. The black line is hiring intentions, the red is labor shortages. And what we are seeing is that labor shortages are ticking down, but they're higher than hiring intentions. So some of the possible employment numbers have to do perhaps with a labor pool that needs a little shifting in terms of skill sets, more coders, more software engineers, perhaps. Sometimes we hear that it is difficult to find the labor that is needed. Moving on to flows, macro earnings plus flows is what makes a market. We see indices testing their first level of support, which is the 50-day moving average. We can see that the bulk of negative flows have been in the fast money systematic strategies. This is this chart here on the left. That's the vol control plus the CTAs plus the risk parity flows. These are the ones that program trade and do not have price sensitivity, but rather focus on mathematical probabilities that have nothing whatsoever to do with valuations or earnings or macro. They are trend followers, and they just make sure their math behind the mandate works. The chart on the right here shows their flows, but as well as the asset managers and the fund flows. Those charts, those flows are in the green, so that's good to see. Another important thing that affects the market, especially when we're nearing a potential pivot, if you know, or if they're try some trigger, some headline that tilts things one way or the other, or just a little elevated volatility, if you will. We see that the growth of the levered ETF has grown immensely. That's your chart on the left. And what that means is that when they have to rebalance at the end of every day, in order to maintain the math behind their levered status, it means that they have bigger and bigger dollar amounts to trade, which feed into the trend and creates a vicious flow cycle that has nothing to do with valuations or any other fundamental metric. So if you thought things are a bit more erratic, or if you're a short-term trader and you see this, this is why. So something triggers both on the upside or the downside, and we get bigger waves of market movement. So it creates a higher volatility at the touch. Some people will try to take advantage of pricing if they think that it's not fundamentally driven, and maybe pick away, but oftentimes it means waiting a long time to see if you're right. So it's not what we do. We're disciplined, as you know, with where our stocks are pricing, and we will wait this out until pricing is on a better footing and volatility subsides. Should prices move lower, you will see us with more cash. Should it stabilize, we will re-engage. This is the flows globally, and while there's been a little bit of a downtick down here, we're still at pretty high elevated levels. This is flows globally everywhere, not just in North America. So they're fairly positive still, which is good to see. The S&P equal weight is trying and testing its second line of support, which is the 100-day. So the suboptimal breadth shows up not only in the performance of the momentum or Mag 7, it also shows up here. Also acted a bit sloppy, but you know, this is broken the 50-day, and it's looking to hold its second level of support. So yeah, we will wait for markets and breadth to look better for the cash, and we'll continue to be disciplined and let the market tell us what to do. For now, it is about momentum. They don't like those. This is a chart of the Goldman Sachs non-profitable company index, and it's down almost 30% from October highs. These are the companies that triggered most imaginations when things were flying high, the non-profitable companies. These are the concept stocks that trade at an infinite P because they have no earnings, so there's nothing in the E part of the equation, the denominator. On Friday, Merrill Lynch noted that retail turned seller after 11 consecutive days with the net notional sold, the largest in 10 weeks of this group. I get it. There is no room for risk in the stratosphere, and we don't have any companies in our client portfolios that are concept companies like this or have no earnings. There is a time for that, but that time is not now. I mentioned that we deweighed gold and took some nice profits, really was in the stratosphere there as well. And so as it was selling off, we saw flows out of gold. This is not to say that it won't stabilize. Actually, the last couple of days, the commodity has actually stabilized and moved up a bit, but it was a meteoric rise in a very short time and overbought. So we took some healthy profits. Nothing in the consolidation actually broke. And since then, some gold companies have actually reported some pretty good numbers. We're looking at this very carefully. Um, One other trigger that I think affected the market very much and coincides with the current testing of levels is the bond issuances that the hyperscalers have done. So this chart shows you the level of capital raised from US investment grade. Then the blue box is investment grade bonds over September and October from these hyperscalers, as we call them. And the orange is just loans, in particular from Oracle. So the theme here is that they have announced their plans for ambitious CapEx spending, and now they have to raise money for those plans. Hyperscalers are those companies that want to build AI capacity, and this requires a lot of investment. So when Oracle, for example, raised money in a bond issue a few weeks ago, there was huge demand for their issuance, but they weren't the only ones that were adding debt. So with a huge amount of CapEx that these companies will need money for, um, more capital raises are sure to come. And yes, these companies throw off a lot of cash, but there is some elevated anxiety around private debt and high yield debt in general, especially after JP Morgan reported on a bad investment during their earnings report time, which I think is unique to that company and doesn't represent the sector, but it coincides a little with the change in the market breadth of late. So maybe there is some rotation and money being moved around a bit. So hyperscaler bond spreads have moved up a little bit, not stressed by any means, but off lows. And this is the chart that shows you the spread between these hyperscaler bonds to Treasury. And we can see that they have moved up a bit. Not stress again, as you can see, it's way off it's still in very manageable territory. But if I was to explain why the market has been a little softer at a time when we have a government shutdown and no macro data and a whole bunch of issuance, then this would definitely be a point. What we see here is a chart of the amount of M&A announced since 2020 by quarters. You can just see the huge level of growth over here on the right side of the chart. This is another important story this year, and this makes the financials continue to be attractive, a sector that we liked for a while now. M&A gives them fee revenue, deal revenue, trading, and IPOs. And so this will be and is a strong area of profit. This year, we have already seen $2.8 trillion in deals, a size not seen since 2014. Part of the reason why corporations merge is the lenient antitrust environment or the more lenient antitrust environment. And another reason has to be tariffs. If companies combine, they can achieve cost savings through scale to offset the tariffs and limit how much of these tariffs corporations have to pass on to the consumers. The flip side is that might cut jobs, but so far we've seen a softening, but nothing to worry about at this point. And then another important theme in this market has been the corporate buybacks, which are very high. And November is the second most active month for the US market. Think about $68 billion of demand to buy every single day. So I have spoken out of both sides of my mouth today. I have mentioned that breadth has been challenging and we have taken our foot off the gas a little. But I have also said that demand for stocks is there. M&A, buybacks, and earnings are very good. So of course, markets will be volatile a little bit given how high things have gotten. And there are many who will jump on a trend at the smallest indication. Overall, it seemed prudent to take the volatility out of the portfolio and take some profits and wait to see if the uptrend reasserts itself, which perhaps it has with the markets holding their first level of support. Bottom line, the slide in front of you is the S&P 500. Over the last while, you can see it ebbs and flows. It touches its 50-day moving average, as mentioned, the first level of support many times. In tactical portfolios, there will be times when it's prudent to press on the gas, and at other times protect from potential pivots. Our short-term indicators are flagging risk, And although a little better today and yesterday than last week, breadth hasn't been optimal. So we have taken our foot off the gas. Finding tops and bottoms is an exercise in futility. And I've yet to meet someone who can do that successfully and consistently. However, prudent risk management techniques can protect your money from these potential pivots with catching the belly of the move, which is what we want to do. And my final point today is portrayed in this chart. The chart in front of you is a chart of financial conditions and stocks. The white line is the Bloomberg US Financial Conditions Index, and the blue line is the MSCI World Index. And we have monetary as well as fiscal support for many governments and central banks across the globe. So that is supportive of stocks. And now I will give the reins over to James to run through the portfolios. Thank you for listening to this overview. I hope I've been giving you a flavor of what we're watching and what's at the top of our minds in our current environment. Over to you, James.
Thanks very much, Diana. So for regular viewers of this call, you'll recognize this chart. It's where we stand from a sector allocation standpoint across the firm. As you can see, and as Diana mentioned, we've raised a substantial amount of cash over the course of the last few weeks, sitting now just around 15%. This will be a bit higher, a bit lower, depending on the mandate. So the volatility that we've seen, as Diana mentioned, has been significant over the last few weeks. And while our positions have generally held in very well, surprisingly well, we have had a few of them break down, so they've been sold. As our process dictates, given where breadth is, we're biased to play some defense here. So the bar for inclusion in our portfolios has come up significantly. Even some of our favorite names from a fundamental standpoint, if the chart breaks, we're going to be unbiased sellers, and that's what we've done in some cases recently. So the cash balances will be slightly different, again, depending on the type of account, but we're pretty defensively positioned here. In order for us to view the market more constructively, maybe just to speak to our process and the way we see things going forward, for us to view the market constructively, specifically the US market, because Canada and global markets have held in much better, we're going to need to see the market broaden. It's definitely not sustainable for only a few highly concentrated names to continuously lead the market higher. You really need broad-based participation for a durable rally. That's what we want to see. It is very possible that when we see a broadening out process occur, we see some new leadership emerge. That's something that's very important to watch, especially on a day like today where we saw the AI darlings off pretty sharply on CoreWeave's guidance. We did see some lagging sectors like healthcare actually perk up and start to look a bit viable here. So we may see a rotation in leadership. At the end of the day, that would be healthy. That's something that we're always watching for, and specifically on the day, it's very important to see what leads. So it's something that we welcome. We aren't married to any of our positions. We're happy to go where the capital is flowing, and hopefully make some good returns along the way. I will say, and it was mentioned earlier, we've stepped out of the way on the gold trade. That's been a theme over the last few weeks on these calls also. But we have seen a bit of a consolidation process occur. The commodity itself has held its 50-day moving average pretty well. To look at the miners, they've also held their 50-day moving average pretty well. It may be time to get involved again. I'm sure that's something Dave's going to cover in more detail next week. But that is something that we're watching closely. We've been on the sidelines, but early indications are it might be time to get involved again. And that's really all that I had. I just wanted to spend a few minutes on process. As always, thanks everyone for watching. Thanks, Diana, for the great content and charts. I hope everyone found this all helpful, and we'll be back next week with the regularly scheduled programming. Dave will be back next week. So thanks everyone, and we'll end it here. Take care.